Hello and welcome to Tchaikovsky's accounting videos. Today I'm featuring some exercises that have been done by Kieso and Weygandt, Wiley textbook, and this relates to asset impairments. So when we're looking at asset impairments, we need to kind of look at a few different things. Are we still using the asset? And this is essentially classified as property, plant, and equipment. Or is this an asset being held? Or is the asset not used, but held for sale? If we hold equipment that we used to use, but are no longer using, this is essentially going to be called an asset held for sale. And when we're looking at the first, when we're looking at impairments here, the thing we need to remember is similar to anything else that is going to be on our balance sheet, is that do we want to be overstating our assets? And the answer to that is no. Rather, we want our assets to be fairly stated. We want to think about this from the investor's perspective. So the first thing we need to do when we're judging an impairment is we need to compare the net, essentially it's going to be we're going to be comparing our expected net future cash flows against the net book value of the equipment. If there, in fact, is a difference between those two, meaning that the net future cash flows is below the book value of the equipment, then we're going to have an impairment. At that point in time, then we need to go through here and then essentially write down the asset to its fair value. And remember, the key thing here is always going to be about if we are continuing to use the equipment. So let's see here, take a look at Suarez company. This is about information about owned by Suarez at December 31st, 2017. So the first thing we're given is the cost, and then we're given the accumulated depreciation. Then we've got the expected future net cash flows and then fair value. So is there an impairment of the asset? So what we're going to need to do here is we're going to need to determine the net book value. And that net book value is going to be the cost of $9 million less the accumulated depreciation taken on the asset to date. So my net book value here is going to be $8 million. So I've got here net book value here of $8 million. And that's my net book value. I then compare this net book value to the expected future net cash flows of $7 million. And because, and we'll call this value A, we'll call this value B, and because B is less than A, this means that we have an impairment. So the next thing we need to go through and do is we need to go through and then identify essentially what's happening next, which is right over here, which is how much do we actually impair it. So the impairment is going to be the difference between, so why don't we call this impairment test, net book value versus net expected, excuse me, future versus expected future net cash flows. And now for the actual impairment calculation, what this will be the net book value or what we just computed up here. And I'm then going to compare this to the fair value of 4.8 million. And so we get right here an impairment of 3.2 million. So this asset has been, or basically there's been a decline of 3.2 million. So the way we need to record this impairment, so the impairment calculation then is going to be if impaired, we're then going to say the difference between the fair value and the net book value is equal to the impairment amount. So right over here, what we're now going to do is we're going to say, okay, we need to impair the asset. So what I'm going to do on 12/31/17 is I'm going to have a loss due to impairment. And this is going to be 3.2 million. Where this is shown on our income statement is going to depend upon the materiality. And then I'm going to have accumulated depreciation on the equipment. Over here of 3.2 million to record loss due to impairment. So that is going to be similar whether we're holding the asset for sale or if we're using our asset. So the next thing we need to do is to prepare the journal entry to record the depreciation expense for 2018. Now with this part right here, we're kind of assuming that it's going to have a remaining useful life of 4 years. We can also assume that over here, that with regards to this, so we're going to basically do here. So because we're continuing to use the asset, we need to go ahead and to then depreciate that asset. So the way I'm going to do this is I'm going to say, okay, what is my current book value look like for this asset? Well, over here, if I took a look at my cost of the equipment, which we said initially was going to be 8 million, or excuse me, 9 million. My accumulated depreciation on the equipment had an opening balance of 1 million. And then I did an impairment here. And the amount of my impairment was 3.2 million. So my total amount over here in terms of my new net book value is going to be the 9 million minus the 4.2 million or 4.8 million. So now this is what I'm going to depreciate over the next 4 years. Now I'm going to assume that this is going to be here. We're going to go ahead and use straight line and then no salvage value. So for part B, we're going to assume straight line depreciation and a 0 salvage value. So what that will be right here is for 2018, I'm going to take my acquisition cost, or basically my carryable cost. We'll call this the current book value, minus the salvage value divided by the estimated useful life. And my current book value is 4.8 million minus a 0 salvage value divided by 4. So I'm going to get 4.8 million divided by 4, or roughly 1.2 million. So to record the depreciation expense, I'm going to 12/31/18. I'm going to debit depreciation expense for for 1.2 million, and then I'm going to be crediting accumulated depreciation on that equipment. Okay, so the important thing here is that, so again, because we're using the asset, we're going to go ahead and continue to depreciate it. Now, on part C, if the fair value of the equipment went up to 5.1 million, what do we do? And the answer to this is do nothing. Once we impair an asset, and if we are using that asset, we do not show any impairment recovery. So if we are using the asset, and if later the asset goes back up in value, no journal entry to be recorded for any impairment recovery. So that's a very, very important distinction between this and the next example that we're going to be looking at. So again, this is the type of the impairment if we are still using the property, plant, and equipment. So again, a very important distinction. So now let's take a look at an example here where we've got the same thing, except that Suarez intends to dispose of the equipment in the coming year. And it is also expected that the cost of the disposal will be $20,000. So we have the exact same scenario here, except now we're in the zone of essentially being right here. And let's just make our lives a little bit easier. So we're now in the zone where we're not, it's not that we're still using the asset. Rather, what's happening now is we're holding this asset held for sale. So this is really, this is exercise 11-16. This is exercise 11-17. So our impairment test is not really going to change. We're still going to have the costs. We're comparing that net book value to the expected future cash flows, and we have an impairment. However, the impairment calculation is going to be slightly different. So over here, we have a net book value of 8 million. We have a fair value of 4.8 million. But what makes this different than the other one before is that here, we're also planning on disposing of this asset. So not only do we have to, we've also now, not only are we taking into account that we need to bring this down to fair value. So my impairment here is going to be 3.2 million. But in addition to this impairment, what I also have to kind of consider is the fact that, well, wait a second, not only do I need to record this loss, but it's also going to cost me 20 grand to get rid of this asset. Now let me get rid of this over here. So this is my disposal cost. So my total impairment loss, or my loss due to impairment, is going to be $3,220,000. So remember, the important part right here is that, well, it's kind of the same as what we just did before, except this is a little bit different. Now that we're planning on disposing of this asset, what we need to do is we also need to accrue for those costs because we know that we're going to be incurring them. So the next thing we're going to go ahead and do is say, okay, here's our impairment loss. Now, how do we go through and book it? It's going to be the same way. We've got 12/31/17. We're going to basically say here, loss due to impairment. And this is going to be the accumulated depreciation on that equipment. And this here will be 3,220,000. Okay. So here's to record impairment of an asset held for sale. Okay, so that is my impairment loss. The next thing I need to look at now is going over here in terms of what is my accumulated depreciation, or how much do I depreciate the asset? And this is very simple. We only depreciate the assets that we're actually using. So here, no depreciation expense, because we are continuing to use the asset. So I don't do anything here in terms of recording any type of depreciation expense. I then look over here. So that's a very important distinction. So if this here is an asset being, if we're not using it, but we're holding it for sale, we record no depreciation on that asset. Okay. So letter C, the asset was not sold by December 31st, but the fair value of the equipment is now $5.3 million. So what we have here is essentially a recovery in terms of the impairment. And essentially what's really happened here is that, well, what are we looking at now? Well, the value of this is no longer 4.8 billion. Rather, this is actually now climbed to 5.3 million. Therefore, we've had an impairment recovery. So under this part right here, when we are holding an asset for sale, and if there is an impairment recovery, what we are going to go through and do is we can essentially recover impairments up to the initial amount of the original impairment. So what we're going to do now is we're going to go ahead and recover it. Now remember, this is different than here. When we were using the asset, we didn't do anything. But here, because the asset is being held for sale, we're now going to have an impairment recovery. Okay, so what I've done is I've brought some of my old friends back here from the last problem. And so when we do this impairment, or this impairment recovery, let's see, prior to the impairment recovery, my equipment had a net book value here. It's going to be $4,780,000. This is what was on my books. And now we're being told that as of 12/31/18, the fair value is going to be 5.3 million. So over here, my fair value is now 5.3 million, but my cost of my disposal is about 20 grand. So my disposal cost is going to be 20,000. So if I were to go through today and dispose of this asset hypothetically, the proceeds I would be receiving would be 5,280,000. So in terms of showing over here this recovery in fair value, I'm going to show here, and remember my rule is I can take up to the amount of the initial impairment. So here my fair value recovery is going to be my net fair value minus the net book value of the equipment, or 4,780,000. So my impairment recovery is approximately $500,000. So what I'm allowed to do, because I'm not using the asset, rather I'm just holding this, I can recover it by this amount. Now, to be very clear, I would be extremely suspicious of something that's been on the books for a year and all of a sudden it's getting a recovery from impairment. I've never seen it, but that's why we're having fun here today in intermediate accounting. So on December 31st, 2018, I'm going to debit the accumulated depreciation on the equipment here for $500,000. I'm going to credit recovery from impairment gain, or just call it recovery from impairment. And my description would be to record impairment recovery. So over here again, I'm going through and doing these calculations, and I can continue to recover this until I can go back up to basically 3.22 million. Again, the key here is when we're doing the impairment, not really different than everything else we've been doing here, except we've got to have the disposal costs. And that's going to be reduced. That's going to be increasing my overall impairment compared to the last question. And then when I'm going through here and I'm looking at this in terms of saying like, okay, now that if I've gone up in fair value, remember that it's really about the net fair value. So it's this fair value minus the disposal costs is getting you this new net fair value here, which you're comparing to the net book value of the equipment. So that is exercise 1117. And let's go take a look at exercise 1118. Okay, so we've got here the management of Petro. Garcia was discussing whether certain equipment should be written off as a charge to current operations because of obsolescence. This equipment has a cost of 900,000 with depreciation to date of 400, and then we've got the fair value. So we can go here and do our impairment test. We'll just kind of change around the numbers. And so here, my cost is 900,000. My accumulated depreciation is 400,000. So my net book value is 500. My net expected future cash flows is 300,000. So I know that I have an impairment. So what's really important here is that this company intends to use the equipment in the future. So what does that mean? If there's a recovery, I don't do anything, but I will depreciate the asset once I've done the impairment. So right over here, the next thing I'm going to go through and do, and we can copy ourselves from again, but right over here is going to be this impairment calculation, which I'm going to go ahead and copy over here from this one over here. And so I've got my net book value of being, my net book value is 500,000 and my fair value is 230,000. So my impairment is going to be 270,000. So what I'm going to do here is that going to be the asset is impaired once I've identified an impairment. Now I'm comparing this net book value to the fair value. So over here, my journal entry is going to be at 12/31/17. I'm going to be debiting loss or call it impairment loss. I'm going to credit accumulated depreciation on the equipment. And then over here, my impairment is going to be 270. And then I'm going to say here to record impairment loss on equipment. Okay. One of the things I always do is I kind of change the way I do my description, and I know it drives my students bananas. Impairment loss, is this the same thing as loss due to impairment? The answer is yes. It's two ways of saying the same thing, which is why I can double bill you as an attorney. So right over here, there we go, some fun legal humor for the day. So right over here, that's my impairment loss. So where should the gain or the loss, if any, on the write down be reported in on the income statement? My suggestion would be other gains and losses, because again, it's not something that you would really say is operating. Again, it depends really on materiality. So with B, it's going to be it depends. Letter C, and remember, when we're going through and doing this in real life as management, these are management's financial statements, and management is going to have to go out and make an initial, estimation. The great thing is the Securities and Exchange Commission's website's out there, so we can be using that to kind of see what's happening. And then what we're going to go through and do is we're going to say, okay, well, what's the best thing for us? So letter C. So letter B, it depends. More than likely, other gains, losses. Letter C, at basically it increased to 260. No journal entry because asset is being held for use. Okay, and what accounting issues do the management face in accounting for this impairment? Well, you have to write down an asset, and then you're going to have to go through and clarify it. Is management, if my assets are in fact going downwards, or if my assets are going down, obviously it does not look like management's doing a good job, but these things happen, and that's what the management discussion and analysis is for on our financial statements, to give those explanations. One of the things I didn't ask for in this question, or what that did not ask for, is like what here would be the amount of the depreciation expense. We would depreciate this asset. So what it would be is you would have the net book value, you would have another 270 here taken from impairment. So your new, basically your new depreciable basis is going to be about 230. And so right over here, basically you're going to have a depreciable basis of about 230,000. And so that would be divided by the useful lifetime, income, or whatever the salvage value might be to depreciate. But we would depreciate it in this case because we're actually using the asset. So that covers impairments. Just in summary, that the key thing is, are we using it? Are we not using it? If we're using it, we record the impairment and we depreciate. If we're not using it, we record the impairment, and when we're doing that impairment calculation, we're also going to be including the cost of disposal. We do not do any kind of depreciation expense if we're not using it. Remember, depreciation is showing the use of an asset. If we're not using it, we don't record it. Lastly, the part here is that if there's a recovery, if we're using the asset, don't do anything. If we're not using it, we can recover it up to the amount of the total impairment we've taken. But just remind yourself that you still have to account for that disposal cost when you're doing that. So thank you very much for watching my video today to this unlisted super secret intermediate accounting video. Please do not forget to like and subscribe, and I will see you on the next video. Thank you so much. Bye-bye.